righty, good morning, sub-tours. Glad to see you guys on here today. Welcome to Goat Talk. We've got tax and entity master, investor extraordinaire, Bill Walston here with us today. Let's see, Bill, welcome to the show. Good to have you.
Thanks, William. It's great to be here.
Yeah. We're going to talk a little bit about some of the things that Bill's going to talk about at Sub-2 Palooza. Guys, if you haven't got your tickets yet, you need to get over there.
Better grab them.
Better grab them. Listen, we got 6 more days on the early bird pricing. And hey, the hotel rooms are about gone. So
yeah, it's going to be a good time.
It is. One of the keys to an event like that is hanging out with everybody after the event's over at the end of the day, and just hanging out in the bar, in the lobby, and talking and everything. And it's really, really a good way to jumpstart your business. I know, even if you've been doing this for a really long time, you tend to get a little bored at times, things like that, but a live event can really change things. It's been a long time since we could do that. So
I'm telling you.
Yeah.
I was just looking back the other day. It's been over a year since I've been to a live event.
Yeah. I can't remember the last one that I went to. So yeah, I mean, we're really, really looking forward to that. So if you haven't got your tickets, get over to sub2palooza.com and get those while we're still in early bird pricing. I want to see you guys down there. We're not going to have a super large group, so we're going to sell those things out. So get over there and get them. Well, Bill, let's see. What are we going to talk about today? We're going to talk about, I guess, the Biden
tax plan, or the Biden not tax plan, whichever one you want to refer to it as.
Yeah,
it's got a great name though, man. You know, American Families Plan. Who wouldn't want to jump into that?
Yeah, exactly. Right? What does that do to us as investors?
Well, right now it doesn't do anything to us. Honestly, everybody thinks that this is a given. It hasn't passed yet. Okay, right. So I guess we should call it the proposed tax plan. Actually, they think that it's not even going to be voted on until August. Right. Okay. So come to Sub-2 Palooza to find out what really happens, because by then we may know. Right. Yeah. So right now it's just just what we think it may be. Right. Yeah. But generally, I would say, in looking at the plan, there's a lot to it that probably would not affect us as investors. So I'll just talk about the things today that would. And the first one is they're going to increase that top individual rate, right? So right now, the top rate is fixed, right? 20-some%. They want to increase that back to 39.6%. And I know that they're saying that it's only going to apply to people who are making over $400,000, right? So anybody making less than $400,000 is not going to be affected.
Yeah.
Yeah. Well.
Yeah. What about the rest of us?
Okay. We'll see. But that is the one thing that they're wanting to do right now, is increase that tax rate on everybody. I think more what hits us is going to be the increase in capital gains taxes, right? So right now, capital gains are the best they've ever been, man. I mean, the capital gains rate, they top out at 20%. And some people, if you are a single individual and you make less than $40,000 a year taxable income, right? Your capital gains rate is 0, not paying anything at all. That's not going to change. What they're going to do is say, once you hit $1 million, and that hits some real estate investors, man. Once you hit that $1 million mark, your capital gains rate's going up to 39.6%. And if you include the investment tax rate of 3.8%, which is separate, you're in the 40-some% bracket on your capital gains if you're making over $1 million. We tend to look at that, I think, as investors say, oh, I'm not worried about that because it'll never affect me. I don't have $1 million in taxable income, right? It's going to, in the long run. It's just the start, right? So that's going to hit people.
Yeah.
So
Well,
that's one of the big changes.
I think everybody's here because they want to have $1 million in
Yeah, I
taxes
know. We
income.
hope so. And then we're all going to be
Right.
suffering, right? We're going to say, oh, no, not the capital gains,
Right.
right? So they're kind of hitting the investors where they hurt. You know, they're looking at the top individual rate because we're all paying those. We're looking at increase in capital gains because we and investors want those right now, right? We want capital gains because long-term capital gains are taxed at a lower tax rate than our individual taxes right now. That's not going to be the case if this proposal goes through and if we're making over $1 million. Okay. Another thing that will hit people, what he's proposing is stepped up basis. I guess you're familiar with that. Like if you inherit property from family or something like that, you get what's called a stepped up basis. Okay, I went through that with my dad when he passed away a couple of years ago. My sister and brother and I inherited, of course, the farm and all the rentals and that type of stuff that he had. We got those at a stepped up basis, which means that what the value was at the date of his death is now our basis. So if we immediately sold all that, there would be no capital gains. There would be no gains at all. All right. If we hold it, and we're going to hold most of it, okay, the basis starts as the date of his death. That's the value of the property, and that's treated like the cost to us. Okay. Biden's proposing to get rid of that. Right. So what would have happened when my dad died is we would have had to have paid taxes on all that increase in the basis. Right. And what isn't clear is he just saying that you take the basis of the person who transferred the property or the decedent, right? And you pay that capital gains when you actually sell the property. That's not what he's proposing. He's proposing you pay the capital gains on it when you get it.
You get it, yeah, when you inherit.
Yeah, and that's a killer. Now he is saying that he's going to exclude family-owned businesses. He's going to exclude farms, right? We don't know. That's saying that, you know, that's still not proposed, right? We don't have a proposal yet. Nobody has even commented and made suggestions or changes to this proposed bill. It's just kind of floating around out there. So, you know, the Republicans are coming in and say, oh, we don't want this. And the Democrats going to come in and say he's not taxing enough, you know, that type of thing.
Right.
So we'll just have to wait and see. But it could be very bad for those people who are trying to do estate planning, right? Because I ran into an interesting situation the other day. I was talking to one of my clients. She inherited a property from her grandmother. She didn't actually inherit it. Her grandmother put her on the deed about a year before her death, right? Just gave it to her. Unfortunately, what that did was it gave my client the basis that the grandmother had in the property. There was no stepped up. So I was telling her, I said, you know, it's a sad situation, but you would have actually been better off if your grandmother had just left you the property in a will or in a trust.
Right.
Okay. And you got the stepped up basis because now she's ready to sell that property. She has a basis of $80-some thousand in that property instead of the $200,000 in the property that it was worth when her grandmother died.
Right.
So I digress. Excuse me, got something in my throat there. Let me drink a cup of coffee, swig of coffee.
Sure. Hey, Rudy, good to see you today. Phil, Andrew says he had coffee and bacon in honor of you today.
Oh, did he really?
Oh, yeah.
I had bacon. I had breakfast for supper last night. That may be a Southern thing.
You know, my grandparents used to do that. I always hated that.
Yeah, but that was from but they're in Georgia, right?
No, my grandparents were in Mississippi.
Oh, well, still a Southern thing.
Oh, I know. That's what
still
I'm saying.
A Southern thing. I had bacon and eggs, and the fur kids and I enjoyed it. It's like one of those piece of bacon for me, piece of bacon for them type thing. Yeah, one of those.
Right. It's like those memes. You know, the dog staring at you says, "I too love bacon."
Yeah, exactly.
Hey, Tammy.
One of the last things, and hope we get some questions on some of this stuff.
Yeah.
One of the very last things that we're going to be concerned with is like-kind exchanges. Remember a few years ago, like-kind exchanges applied to any type of investment property. Didn't make any difference what it was.
Right.
Then with the Tax Cuts and Jobs Act, it said, nope, like-kind exchanges only applies to real estate. Well, you know how that happened. There were a lot of real estate investors in Congress, and the president happened to be one. So we kept like-kind exchanges for real estate. The proposal is to get rid of that. No more like-kind exchanges. Now, they are going to, there is a proposal, and part of that is that it only apply to gains over $500,000. So if your gain is $500,000 or less, you can still do a like-kind exchange. If it's over 500,000, you can exchange 500,000, and anything over that is going to be taxed. Where do you think they may have gotten that $500,000 amount? Capital gains exclusion for sale of primary residence is 500,000 if you're married filing jointly. So I'm thinking that's what they say. Oh yeah, that'll make it fair, right? Everybody has to be fair.
Well, it sounds like they just basically want to gut most of the advantages of real estate.
Yeah.
Yeah.
Well, I don't know if they went after real estate specifically. I just think that those were advantages to real estate investors. Right? Because capital gains applies to all types of investors, not just real estate.
Right.
So it's going after the supposedly wealthy people, right?
Yeah. Well, yeah.
So I guess we'll continue to apologize for that.
Yeah.
Anyway.
Hey, Tammy, good to see you. Tammy's from Texas. She's in here today. Tracy says, I told my tax guy about Bill. I'm going to send him a link to this after so he can revolutionize my taxes. Hey, Farouk, Sarah, good to see you. Hey, guys, if y'all have any questions at all, we're just talking about some of the topics Bill's going to talk about at the Palooza. But if y'all have any questions, tax related, entity related, or just investing in general, let's have them. We'll get those covered this morning. So,
yeah, like I said, guys, you can come to Palooza and find out what the real scoop is by then, because we should have a more firmed up plan. Right now, it's just speculation, right? We have some good ideas of what they've been trying to do for a while, but nobody knows for sure. Nobody knows for sure.
Yeah. Well, I think, I think what the politicians do initially, they put so much crap in there, and then you're like, oh my gosh, they're going to take away this, they're going to take away that. So if they can cut that down just a little bit in the bill that goes through, you're like,
right.
Oh,
we think we've dodged a bullet, right?
We won, right?
In marketing, right? If you ever studied marketing, remember when they used to talk about we'd float a balloon, right? We'd send an idea out there, let it kind of circulate, and you let people talk about it and give their opinions on it without really asking them what their opinions are. Right. I think this is kind of similar to that. We're in a similar type of situation with it. So they've just kind of floated it out. Now, one thing I didn't like in this is the proposal on the most of these. I think tax advisors are pretty confident that none of them are going to be retroactive, and that they, if it's approved during this year, they would probably go into effect for 2022. Right? So it's not like, boom, we got you. Did you know the exception to that is going to be the capital gains changes? Biden wants those to be made retroactive to April of this year, meaning if you did any type of transactions from April on, that that the new capital gains structure, whatever it may be, apply to those transactions. I've not seen that before. Really, I'm not saying it hasn't happened. Right? I have not seen that happen where they've made these tax changes retroactive before the bill is even passed. Said that they were going to be retroactive. So it's kind of an interesting situation.
Dana's got a question. When leveraging your self-directed IRA for real estate investments, should the self-directed IRA be in the LLC or your personal name?
Okay. I think probably what Dana's talking about is what they usually call an LLC checkbook IRA type thing, right? The IRA should be the owner of the LLC. Okay, is how that would work. Your personal name should not be in there anywhere. Okay, because that could be looked upon as you self-dealing with your IRA. Can't do it. Now, what a lot of people don't realize is you can actually be the manager for that LLC.
Right.
Okay. But it's owned by the IRA.
Right. I know several years ago, I had a friend who, when they were really just getting these self-directed things started, it was, gosh, this, you may know Steve Case. He was,
Yes.
we were buddies in Macon, and he had his thing. I mean, like I said, this was new, relatively new at the time.
Right.
And so what we did was he started his self-directed IRA with some company, and I can't remember which one.
Probably Equity Trust.
It was an old one. No, it was back when there were only a couple, I believe. I want to say. But what he did was and then took a withdrawal from there and opened a local bank account with a checkbook. And then I was the trustee for that. So I signed the check. And I don't know. Well, this is a private group. I don't know. But basically what I did was just signed all the checks in the book and gave him the book.
And gave him the book. Yeah.
Yeah.
And you know what? That's kind of, you know, I think it follows the letter of the law, maybe not, basically. Yeah. And that's really kind of how the checkbook IRA works. The LLC, we sometimes call it LLC IRA. Right. So essentially what happens is an LLC is formed with your IRA being the single member of the LLC. Okay, you can be appointed the manager of the LLC. The LLC opens a bank account. The IRA funds the bank account, right? So you actually transfer the money into the LLC bank account. And then as the manager, you just, sign the checks and contracts and things like that. It works really, really nicely because one of the problems that people have in investing with their SDIRA, if you are not doing the checkbook IRA type thing, the IRA custodian has to sign all the documents, like the purchase and sale agreement. You as an individual cannot sign a purchase and sale agreement for your IRA. Okay, you have to send paperwork to the custodian who has to sign the paperwork. That can take a long time, right? You might find a deal and want to do the deal, and it's like pulling eye teeth to get damn purchase and sale agreement signed.
And back during that time, things were even more
difficult. Right, because nobody knew how to do it. They didn't know what they were doing, right? So, in the situation you have with the checkbook LLC is you negotiate the sale, you negotiate the purchase and sale agreement, you sign it as the manager, okay, on behalf of the LLC, right? But then all the earnings and stuff like that don't flow through to you as an individual. They flow back up through to the IRA, and it's a disregarded entity as far as IRS is concerned. So if it's a single member LLC, you don't even have to file a tax return.
Right. And those are the things you're going to be talking about, the more advanced stuff in the Saturday.
Yep. And we can, we can walk through the requirements because the operating agreement has to be very, very specific. There's got to be certain clauses in the operating agreement of that LLC in order to make it viable and to make it tax-free. Or tax deferred, whichever type of entity you got. And yeah, I think we got a session on Saturday morning. Right. For the coaching students.
Right. The bonus day for the coaching students, Bill's going to talk about some advanced stuff and how to use your retirement accounts. And also Equity Trust has signed on as a sponsor. So they're going to be there. They're going to be there and do a presentation actually, and they'll be able to help you get your self-directed IRAs started up if you don't have one.
Yeah, that's great.
So, yeah, they're going to be there. So we're excited about that. And Dana, as a coaching student, if you're there at the Palooza, you get that bonus day. So make sure that you come out for that. So we're looking forward to it. Okay, guys, if you have any other questions, let's have them. Kevin wants Bill to recap the step up and the law and what the proposal is. I guess the step up basis.
The step up right now is that when you inherit property or it goes into the estate, okay, and you inherit that property, whatever the value of that property is on the date of death, not the date that you get it, but the date of death of the decedent, that sets the value of that property. Might have to get an appraisal done if it's real property, something like that. But that That then becomes the cost basis to the person who inherits the property, right? So let's say that there was a property that was purchased for $100,000, and the individual died. The property is now worth $300,000. Well, whoever inherits that property, the cost basis of that property then becomes $300,000. That's what we call a step up in basis. It steps up from the $100,000 to the $300,000. Somebody says, well, what happens to the $200,000? Nothing, right? Nothing happens. It's just kind of like it didn't occur, okay? The proposal is that, and let me back up just a little bit. Then, Kevin, if you sold that $300,000 property a few weeks after you inherit it for $300,000, you'd pay no taxes. Okay. If you sold it for $400,000, you would pay taxes on a $100,000 gain instead of on a $300,000 gain. So there's a big difference there. Okay. The proposal is that let's take that same property that the individual purchased at $100,000. It's worth $300,000 when you inherit it. The proposal is that you pay taxes on that $200,000. Not when you sell it, when you receive it. So you're paying taxes on, and it's really contrary to tax law, or what has happened with tax law, because ordinarily the code does not tax gains until they're realized. We have a lot of unrealized gain out there. And so what we would have with that particular property is an unrealized gain of $200,000, right? Because it's worth 300, it's valued at, it was a cost basis of 100. So you got an unrealized gain of $200,000 sitting in there, okay? The proposal is that you pay taxes on that $200,000 when you receive it. Now, old tax law would say, hey, yeah, if it's going to be taxed, it's just going to be rolled over. You use a $100,000 cost basis, and when you sell the property, if you sold it for $400,000, you would pay tax on a $300,000 gain, right? The $200,000 that was unrealized when you got it, and the $100,000 markup. Proposal doesn't work that way. The proposal says you get it at $300,000 value, you pay taxes on the $200,000 gain right now. If you sold it a year later for $400,000, you would only pay taxes at that time on the additional $100,000 because you already paid taxes on the two when you got it. But that's screwy because you're paying taxes on something you haven't realized yet. You really don't realize that gain until you sell the property for $400,000.
Okay.
Does that make sense? I know that's kind of rambling.
I mean,
it makes total sense to me, but sometimes it loses a little in translation.
Exactly what you're saying.
But in other words, guys, if you inherit property, you're going to be screwed.
Okay, let's take this a step further. Let's turn this into dollars, which everybody gets. Let's just say this whole Biden tax thing passes. They get their new capital gains percent, everything else. Let's take the same example that you gave. You got a house that had a basis of 100,000 when your parents died. They left it to you. The stepped up basis now is 300,000. You've got to pay taxes on an unrealized $200,000 immediately. Yep. So what's your tax bill on nothing that you've received?
Well, all right. So let's say what your tax bill would be right now. Okay. If your tax bill was right now, $200,000 is in a 15% tax bracket.
Okay, but we're
let's take it back. No. I would say we'll have to back it up a little bit because right now you wouldn't pay taxes on it. Okay, you would get $300,000, right? But on the unrealized $200,000 tax gain, the way they are setting it is that the capital gains is not going to kick over until you do the $1 million. Okay. So the 15% is still going to be the highest tax rate.
So you're still going to have to write a check for $30,000.
You're still going to have to write a check for $30,000 under the Biden tax plan, even if the capital gains rate doesn't affect you. That would hurt my feelings if I had to write that $15,000 check. I don't care if the tax rate is only 20%.
Oh, and if you're $1 million earner, when
It
this
would be
happens,
almost half. If you're
right,
$1 million earner, you would pay almost $100,000 on that gain that year. And where is that
right.
$100,000 going to come from? Because you didn't get it, you didn't
Yeah.
sell the property, so you didn't get the.
It's like, it sounds like it's going to create situations like we've always heard about people on, say, The Price is Right, who won a car and had to sell it because they didn't have the money to pay the
And
taxes.
you know what? That's one of the things that a lot of tax people are pointing out is the fact that in order to implement that, in order to get the money to pay the capital gains when you inherit the property, you're going to have to sell off other assets, or this
Right.
one way or the other. You're going to have to probably sell assets in order to pay the taxes.
Well, I can see where a large percentage of the population that inherited property that their parents had owned for 40 years,
There you go.
a personal residence, anything else. I mean, they'll have to sell it. They can't afford to pay for that.
Yep.
Yeah.
But William, it's not going to affect you, right? Because they're only going to tax people that have $1 million. Well, I'm not in real estate just to
That's right.
earn less than $200,000 a year.
That's exactly right. Yeah.
And not only that, we're talking about inherited property. We're not talking about the income.
Right.
So sometimes it's very easy to be up in that type of bracket,
Yeah. Ed says, we're great. Well, thanks, Ed. You're pretty special too. Don says you actually helped them set up a retirement account, so he loves it. Farouk, sounds like if the law changes, it could be used by investors as leverage to buy houses from motivated owners who inherited. We've already been thinking about that. Farouk.
Well, all right. So, but here's the problem with that. Okay, if they sell it to you, they still have the gain.
Right.
That's not going to help them with the games. So
no, but they
I
get
think
they get the money to pay the taxes with. They're still ahead.
Well, you know what? I didn't even think about that because I wouldn't have been giving them the money.
Well,
I'm a creative. Listen, when I buy property, I buy property with creative financing, so they're not getting money from bills. So that ain't gonna work for them.
And that totally takes away the question that we were talking about earlier this morning that was in the forum yesterday about a document that points out the tax benefits of selling. I guess
there won't be one.
There won't be one. That's right. Right.
And that was a real good question that Albert posed as well. It made for a really good discussion. So if he's on here, say thanks for that question, man.
Yeah. Albert, I don't know if you're on here or not. If you are, say hello. Tammy says, good morning, good stuff. Kevin says, I can see this making probate very attractive.
Probably.
Hey, Lisa, good to see you this morning. She says, hey, William and Bill. Greenwood Homes, if the Biden tax law on step up is passed, what can we do then to minimize the tax? Move to maybe Puerto Rico.
Yeah, Puerto Rico is a territory of the United States.
No. Well, that was kind of a joke, but yeah.
Oh, I understand.
Listen, I just move out of the country.
Well, and
evade taxes.
All right, so here's the thing about the tax plan. It is going to make tax planning a bit more difficult. Okay. There are some things that you could do, but probably you couldn't do it if you were an investor buying their property, right? But as far as an individual, remember I told you that this gal had gotten the property from her grandmother. Her grandmother put her on the deed to the property,
right?
Okay, which dropped the basis back to what it originally was. I think more people are going to be doing that. They're going to start transferring properties prior to their death.
Okay, I see.
And what that would essentially end up doing, and this is just a guess, right, guys? So it's just based on what I've seen in the past, the things that you can use for estate planning. And one simple change of wording in Biden's proposal could change this whole idea, right? But what you might want to consider if that proposal went through, if you have parents, have them start transferring property and stuff to you now, okay? Because what would end up happening is you would end up with their basis, but it wouldn't be realized until you actually sold the property instead of when you inherited it, because you're not inheriting. Does that make sense? Remember, because we said what was bad about this situation is that when you got the property, you'd have to pay taxes on unrealized gain. You can defer that unrealized gain by going ahead and getting transfers of property prior to their death.
Right. Scott says, but Puerto Rico has a 4% corporate tax rate and no capital gains.
That's right, for income earned in Puerto Rico.
Well, there you go. Hey,
that's Scott. That's for income earned within Puerto Rico. If that income is earned within the United States, okay, it's reported within the United States.
Scott, it's hard to beat the tax man.
It really is.
We need we'll have to be spending more time with Pete Fortunato and those guys, because they sit around all day thinking how they can work all.
Oh, I know. I love Pete. He's absolutely hilarious. He always says he wants to die owing the IRS.
That's, I was talking to somebody about that, I think yesterday. And, when I first met him, he told me his retirement plan was to die in federal pen for evading taxes. So
a cot and 3 hots.
That's right. Farouk asked, Bill, can you touch on the installment sale and how it is taxed currently? I have conflicting info that even if I sell on installment sale and take my equity and payments over time, I still have to pay tax on the entire equity. Is that correct? And okay, so Bill, I'm gonna let you answer that. I know how that works.
Well, all right. So part of that is correct and part of that is incorrect. If you do an installment sale, you will end up paying taxes on your equity, which is actually the gain portion, basically. You will pay it, but you don't. There's a difference in paying it all at one time and paying it over the life of a loan, right? So the way an installment sale works is you sell the property, you realize the gain. The gain is expressed as a percentage of the total amount that is financed, because if you sell the property with creative financing, you take a note back. Okay, that note consists of 2 types of return. One is the capital gains portion of the return, and part of that return is cost basis return, right? And so what you have to do is figure what we call the gross profit percentage. And the gross profit percentage amount, the amount of that payment that you receive each year, that is profit percentage, that's what you report for taxes. And if it's a long-term capital gain, you report that amount for as a long-term capital gain on the tax return. But it basically takes that gain. Let's say your gain was $200,000. That's the gain on your sale. Okay, instead of reporting that $200,000 capital gain all in one year, if your loan is for 20 years, right, you would report $10,000 a year over the 20 years as capital gain. Does that make sense?
Yep.
Okay, do I explained it?
Yep, it does. I think part of what he may be talking about too is the whole dealer status. Thing.
Yes. Okay. And here is the problem. If you are classified, and I almost made the same mistake that I get on everybody else make. You are not classified as a dealer. The transaction is classified as a dealer transaction. Okay. What a lot of people don't realize is just because someone calls you a dealer or you do a dealer transaction, that doesn't make you as an individual a dealer. The transaction that you're doing is a dealer transaction. And you, as a taxpayer, right, or as an investor, you can have dealer transactions and you can have investor transactions. All right, you have to know the difference between the two. But let's say that this is considered a dealer transaction. You can sell on a note, that you collect the note over a period of, say, 30 years. However, you cannot defer the gain. You got to report that gain all in the year that you make it, because you cannot report the gains on dealer transactions on an installment basis. Even if you collect the money over a 30-year period, you've got to treat it as though the sale was made all in that 1 year. That's where people get kind of screwed, because let's say you did an installment sale, which means you didn't get your money all up front, right? if your transaction is classified as a dealer transaction, you have to report it all in the year of the sale, which means you might pay taxes on money that you've not even received yet. That's why you have to be careful how these are structured.
Right.
Okay.
Yeah. And don't just report it as a dealer transaction. Let them determine that. That's my stance on it.
Right. Well, and here's the problem. There are some accountants who are going to make that decision for
right.
you if you do not know how to explain to your accountant what you have been doing. Right. Okay. So just because you buy a property and you turn around, you sell that property immediately, that doesn't necessarily make that property a dealer transaction. There are a lot of reasons that investors choose to sell property. Okay, so let's say that you are you usually buy properties and you hold them as buy and holds, as rents. Okay. If you do that and then you buy a property and you sell it 3 days later, one of the reasons you may done that is you got a deal you couldn't refuse, right? You got an offer that you couldn't refuse. You could use the money for capital to invest in another rental property or another investment property. Those are all valid reasons for selling a property. Those would probably be excluded from dealer transaction. Even in an audit, they would be excluded from dealer transaction. So if you can prove why you sold the property and it was following your investment purposes, okay? And we talk a lot about investor intent. What was your intent when you bought the property, right? If you had the intent to buy that property as an investor, then it's not going to be classified as dealer transaction. And you're going to be okay with that. All of my transactions are investor transactions.
That's right.
And I deliberately structure them that way. Now, for those of you who are concerned about that, about whether the property is going to be classified as a dealer transaction or not, hold the property for a year. Instead of selling it and doing owner financing outright, there is this little transaction called a lease with an option, and that would completely eliminate dealer status for that particular transaction. Yep. Because your intent was to rent it. Okay. Now, you are going to sell it at the end, but do you have a fixed sale if someone has an option on that property? Are you guaranteed that that's going to be a sale? Are you? I would say no, because where is the determination? Who makes the determination whether the property is going to be sold or not? Not you. It's that optionee.
Yep. Your tenant
has the option, because if they choose not to exercise their option, guess who holds the property for another period of time? Okay, so I've worked with a lot of clients whose concern was, well, if I get audited, am I going to be considered a dealer on all these properties I turned around and sold? Well, you may be, but one way to make sure that that doesn't happen is to use a lease and option deal.
All right.
Good just my opinion.
Yep.
Just my not so humble opinion, I would say, probably.
Guys, can you imagine having access to Bill for 2-3 days? Okay. So that's what you'll get at Sub 2 Palooza. I mean, we rented for our coaching students, we rented a full deck of the city of New Orleans. We're all going out for a dinner cruise, jazz band, bar, and just the whole 9 yards on Friday night. So if you're a coaching
those
group
folks
student,
don't know what they're going to miss if they don't show up.
Absolutely. Yeah. Hey, Renee, good to see you. Yeah, you're coming in late. Well, good to see you. Glad you made it. Yep. We're going to have this up. You can watch it later. So any other questions you guys have? Hey, give us a like if you're liking the information. We need Scott. We need Bill on demand. That's right. Well, hey.
Well, come to
Sub
2 Palooza, and that's pretty good. That's going to be pretty close. We're all going to be there networking. We're going to be talking to folks between sessions. We're going to be talking to folks after, at dinner. There's going to be a lot of access to some of us that is not usually available, honestly.
Well, I'm excited about meeting a lot of these people face to face that I've talked to for years and haven't met face to face.
I know we've talked for a long time.
Yeah,
right?
I don't know how long.
We've
Yeah,
never met in person.
that's right.
It's
Never
funny
have.
about how social media works, right?
Mhm.
And it makes it seem like you know somebody even though you haven't met them. One of my very best friends, okay, we were besties for a long time. I never met her until we went to an event in Denver, Colorado. And
Mhm.
we'd been very, very good friends for going on 3 years at the
Yeah.
time, had never met.
Yeah. Social media has definitely changed things. Scott Plummer, I'll be there. I know Plum Dog's going to be there. He was one of the first ones to get his tickets. Hey,
Yep.
Steve, good to see you, all you guys. Hey, if you got any questions, again, put them in here. Let's,
And they don't have to be related just to this,
yeah, they
right?
don't.
I mean, yeah,
Any tax or
any
energy
type of
question.
tax question will be fine, or any type of entity question
Yeah.
would be fine.
Okay. All right. So we've covered the Biden thing. We want to talk a little bit about retirement plans. I know Equity Trust is going to be there. This is really the advanced topic that you're going to talk about on Saturday with the coaching students, but we can talk about it just a little bit here
Sure.
and give everybody
And
a little
basically, it
teaser.
boils down to how can I use money that's in my self-directed IRA? Or
Mhm.
even better, if you have the type of entity that allows for it, some folks ought to be looking at a 401k, a solo 401k. Here's
Mhm.
the deal. You'll see a lot of people say, oh, 401ks are the worst thing that you can put your money into, blah, blah, blah. Well, maybe if it's a corporate sponsored 401k at your W-2 wage job,
Mhm.
yes, okay, but not if it's one that you set up for your own business,
Right.
okay? So if you have a 401k, people think that self-directed IRAs are very difficult to invest with. They're not. We've already talked about one of the best ways, I think, to use the SDIRA is with the Checkbook LLC, okay?
Mhm.
A 401k plan that you set up for your own business is even better. Okay, I mean you handle the money, everything. You are considered your own trustee.
Mhm.
So you you fund it with money from your business, right? And then you can have just about any type of investment. There are some exclusions, some things that you can't invest in, but most of the time we're looking at real estate and those types of investments anyway, right? Your 401k can partner with others with your investments, but essentially you can run just about any type of business or any type of real estate investing through those types of plans that you want. You have to be careful though. If you hold rental property in a SDIRA, there may be some tax consequences because we have UBIT, okay, unrelated business income tax, right? We also have unrelated financing income taxes. So those come into play when you have leveraged property because you haven't have leveraged property in those. And you may owe some tax because of that. If you structure it correctly, you're not going to. I love SDIRAs for flips. Okay, I love them for contract assignments. You can assign contracts with your SDIRA and for sub 2 deals because there's no recourse debt on sub 2 deals. We've not signed on any type of loans or anything like that. So it's a perfect type of property to put into because you don't run into that UBIT. That's usually on leveraged property.
Mhm.
Okay. Your sub 2 deals are not leveraged unless you sign a note back to the seller.
Right.
So those are some of the types of things that you can do with your SDIRA. They're great for private lending too. If you're going to be a private lender, you ought to do it through your SDIRA.
Right. I know you and I talked on a podcast several months ago about the differences. And I'd always heard that the IRA was the way to go. And you had explained how it can be beneficial to do the 401k in some places,
Right.
even more beneficial to
Yep.
use that. So if you guys didn't catch that podcast, you can go back and listen to that on Apple or on the podcast website. Sarah said, Bill, we had estate planning done and the lawyer did separate trust for my husband and I. This was several years ago. I had another attorney look at my estate planning recently. He recommended a community trust with both of us, not a blended family. We have 2 adult children and grandchildren. Can you put everything in one of our trust?
You can. All right. I would have to go back and look at some of the stuff and see why your attorney wanted separate trusts. And I think the key was, you said several years ago, right? And some things have changed since then. So a lawyer who is reviewing these may be thinking of some things that should be done because of the changes that have happened since your trusts were set up. That's why I always recommend my clients, you ought to check your trust and have them reviewed every few years. Your wills ought to be updated yearly because of things that take place because of that. I would probably say that you're in a community property state, and that's why he's saying that you probably want to use a community trust. I've seen that recommended quite a bit. And it's a very specific, it sounds like a very generic answer, and that's because I'm not, well versed on your financial situation. So that's the best that I could do. But it sounds reasonable if that's what you're asking.
So, Bill, you do consulting for people and work with clients like that. Isn't that right?
Yes.
Okay. So how can they get in touch with you if they wanted to talk to you about setting up trust? Or she's in Tennessee. That is community property.
Oh, is she?
Yeah. That's what she said. Is it not community property there?
I don't think so.
Okay. So
Yeah,
like
I'm pretty sure it's not a community property state.
Right. So if Sarah, for example, wanted to contact you about setting up an estate planning mechanism or anything like that, how would they reach you?
Well, I'm in Facebook.
Right.
That's one of the easiest ways. I'm in your group.
Yeah, that's right.
Quite a bit. So Messenger, if they want to do an email, it's bill@billwalston.com for an email. Those are the two easiest ways. Messenger, frankly, is usually the easiest for most people because I'm very accessible that way.
Okay, great. So you guys just contact Bill if you want any help with getting that stuff set up. Maybe have him take a look at what your attorney did. Guys, we got a few more minutes if y'all have any other questions on anything taxes, entities, self-directed IRAs, just investing questions in general. We'll be glad to answer those for you. So we're going to be in New Orleans September 9th, 10th, and 11th. You getting in on Wednesday?
I'm coming in on Wednesday evening.
Okay. We're going to have a mixer there in the hotel and the bar, appetizers, drinks, whatever.
Oh, you had me at bar. Okay.
Yeah, there you go. See?
Just kidding. As long as we have coffee.
Yep. Yep. Hey, Chris, good to see you. Can't wait for the Palooza bonus day. And listen, we got 4 speakers that day. Bill's going to be there. Bill Bronchick's going to be there. Richard Roop's going to be there. I'll be there. Scott Horn. I guess it's 5 of us, actually. We're going to be talking about all advanced topics. So, man, that is going to be a super, super day. Small group, so, I mean, questions answered right there. It's going to be great. So like we were talking, we're going to kick it off Wednesday night. We're all going to be sitting there in the bar, having some drinks or soda and having some appetizers, just talking and chatting, talking about real estate. And then we're going to kick it all off on the 9th, Thursday morning early. So Bill's topics are the Biden tax plan. We'll see what's going to happen between now and then the advanced topic on Saturday. So anything else new, Bill, that you want to talk about or throw out there?
Nothing new. Sometimes we say same old, right?
Yeah.
We're just kind of waiting to see what happens when the dust settles. And we don't know yet.
Yeah. I feel like it, like I said earlier, it'll be like most things. It'll, they throw all that out there. They get everybody in a panic. And when only half of it goes through, they go, man, we dodged a bullet that time.
Yeah.
And they go, we got a little bit, we'll get the rest next round.
Right. Absolutely.
Exactly what they do.
Yeah. And what's really interesting is that, the current administration came in saying they wanted to change everything. They wanted to get rid of some of the things that Trump put into place. If they really wanted to do that, all they'd have to do is wait. Those things expire. They were not permanent. Right. A lot of people think that they were permanent changes. Wait a few years and it expires. So the rates, the tax rates go back to what they were before. Capital gains rates go back to what they were before. Okay, those types of things, they were not made permanent. What was made permanent were the business changes. You remember the Section 199A pass-through, which essentially says if you have a pass-through entity that passes the income to your personal tax return, like a Schedule C, like a partnership, like an S Corp, okay, that you have that 20% deduction. That was made permanent. Okay, now Biden may try to get rid of that. There's been no mention of it, okay, in any of his proposals, but we would have to wait and look to see if that happens. But he could have just sat around and waited, said, okay, we'll just wait for all those changes that were made by the previous administration to just expire and go back to normal. Okay. Some people said the Republicans actually left that in the bill for them to expire so they would get reelected to put them back in again.
Oh,
There may be
politics.
some merit to that
Yeah.
assumption.
Yeah.
Right?
But
we'll not get political.
I've been reading the last couple of days. It looks like they may actually let the foreclosure moratorium expire at the end of this month. What do you think about that?
Instead of extending it?
Yeah.
I think they need to let it expire.
Yeah. I think
all they're doing by extending it is just kicking that can down the road, man.
That's right.
You know what I'm saying?
Yeah.
So it's like a deferral, like tax deferrals, right? My tax professor used to say, yeah, best tax plan is defer, 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 die.
Yeah.
Which means that you don't ever pay the taxes. It just falls on whoever inherits all your property type stuff, right?
Yeah. Well, like we were talking before we got on here today, I'm starting to see some slowdowns and some bigger price reductions. So I think the market's already cooling a little bit. But what do you think is going to happen if they do let this thing go through? An article I read yesterday, of course, they like to sensationalize everything, was that possibly 8 million people homeless because of the foreclosures start up again and everything, and what that's going to do to property value. All these people have been paying $100,000 over market value. They got a $400,000 house they paid $500,000 for, and now it's going to be worth 300 here in the next.
Well, and here's the thing. We don't know whether true values are going to drop just because foreclosures can start, right? There's always been foreclosures.
Right.
The foreclosures have been around when markets were good. Foreclosures have been around when markets were bad. Foreclosures have always been there. I think we're going to see, somebody said, oh, there's going to be a tsunami of foreclosures.
Yeah.
I don't know if there will be.
Right.
Okay. Because when the moratorium is over and foreclosures can start, there is still what is called a loan modification.
Right.
Okay. So I don't know if the banks are actually going to let all these foreclosures go through. Just because, that all thing I say a whole lot, you've heard me say it, just because you can doesn't mean you should. Okay. Right. Just because the bank can foreclose doesn't mean that they're going to. It's just that there's the possibility. I could be totally wrong. Right. But I just don't know whether all these foreclosures I don't think it's going to be like overnight. There's going to be billions of foreclosures that take place right then. That's just my opinion. I think that banks are going to try to do loan mods and stuff like that prior to foreclosures, because the old thing about a foreclosure is banks don't like them any more than anybody else does because they don't want to own the property.
Yeah. That's right. I know I read something a few weeks ago that said that, Bank of America and some other major lender, maybe it was Chase, could start this year, but Wells Fargo had already said they wouldn't do anything until next year.
Right.
So they don't.
So I see where that author might be getting a theory. I think that's what it is. I mean, because, we know that if the government says that, okay, banks, you can foreclose, all that does is give the banks the right to foreclose. Doesn't mean they're going to.
Right.
So, I am not of the opinion that we're overnight going to see the market flooded with foreclosures. Yeah. I do think that there is going to be a lot of opportunity for investors. That I do see. Yeah. That I do see. I think we're going to be able to see more sub-2 deals because I think we're going to find sellers who are going to want to get rid of that loan so that it won't be foreclosed on. We're going to be back into that situation, I think, like we were in what, 2008, 2009, where sellers were just like, please take my deal, right? Take my property, pay my loan.
I'm looking forward to those days
I mean,
again. Actually, I'm having
don't,
to work
yeah,
too hard right now.
don't you have that same idea though, that it, I look at more as, I'm not worried about all the foreclosures there. I'm looking at all the investor opportunities that are going to be there.
Right. Kevin said the CDC extended the national eviction ban through July. The source was CNBC. Okay, that's the
Well, that, all
eviction
right,
ban.
number one, that's an eviction.
Right.
Doesn't have anything to do with the foreclosure.
Right.
Okay. And I totally agree. But you know what? There's some, was it Texas that filed that law that said that CDC, they filed a case that said CDC doesn't have the right to make a national decision. I don't know that that case has been ruled on yet. I should have followed it more, but I haven't yet.
Well, that was my next question. And of course, I've had this for months since they first did it. Since where does the Centers for Disease Control have the authority to enter into real estate law and
Right.
make, I mean,
Right. And I believe that when they initially did that, it was challenged in court. And there was a federal judge who said, you can't do that.
Right.
Okay. And that has already been a ruling. There was a federal judge, and if I remember correctly, that judge was in Texas that ruled, hey, CDC, you have no right to make this ruling. And so it was challenged in court. And honestly, I did not follow it after it was challenged. So I don't know what the status of it is. I don't know if it was appealed and the appeal was granted or what have you. But there are challenges to the CDC for that. And I will try to look it up and see what it is, because now I'm curious again.
Leighton just said, Supreme Court said the CDC doesn't have right over evictions.
There you go.
Well, how in the heck can they extend it if Supreme Court's already said? I don't know.
I wasn't sure that had gone up to the Supreme Court yet, so I'm going to have to take a look and see. Shame on me. I usually read those things for fun, and that's just not one I've read lately. I've been reading tax court decisions, not Supreme Court decisions. I should have.
Yeah. Renee said homeowners have to qualify for loan modifications, and if they're unemployed, they won't qualify. So
that is true.
I guess.
Okay. And what's interesting on that, I have a client. Okay. One of my clients who's an investor, and what she will do sometimes, if the homeowner does not qualify, she helps them qualify. Mm-hmm. Okay, there are ways that you can help the homeowner qualify. Rental income, if they can lease that property out or something, that can help them qualify. So if they can turn that into a rental property instead of it being a residence or something like that, a lot of banks will say, okay, this is dire circumstances. You're having to rent the property out to save it, right? We'll do that. So there are other ways to get them to qualify for a modification.
Right. Kevin said, yes, loan mod, call Kev. Absolutely. Kevin Strong, if you guys are wanting.
Is that what Kevin does? Cool.
Kevin does a lot of stuff, but he does loan modifications. He teaches investors how to do loan modifications. So,
very good. He's going to be busy.
Yeah. If you want to learn how to do that, how to help sellers, maybe if somebody's going to sell you the house, you want to try to get a loan modification pushed through before you buy the house, call Kevin. Kevin, put your number up there. Kevin's a sponsor of the podcast.
Hey, ask Kevin a question.
Sure.
Because I know there are some states who have state rules and regs about people helping other people doing loan mods. Is he aware of any of that?
He is. I've heard him talk about it. I think we talked about it. If you're doing it not from a profit standpoint, I think that matters. If it's not
your business to do those. Gotcha.
Right.
That's quite honestly, that's what I was thinking, that you can be kind of like a friend coming in and helping.
Another Kevin Davis said, just took one down this week that was in forbearance and still is until September before it comes out, and then deal with any negative escrow. Good for you. Great.
I've got clients. I've got some folks who are doing the same thing. Absolutely.
Right.
Got a gal in North Carolina that she tears it up with the banks.
Right. There's Kevin's number. You guys give him a call. He's a great guy. Like I said, he's a sponsor of the podcast, and and he can help you learn how to do that, how to help some sellers out and maybe restructure some stuff before you take over their payments. Leighton says, looks like Biden has asked for an appeal to the eviction moratorium and judge did grant temporary hold. So,
Okay.
What can you do? All right, guys.
Bless his heart.
Yeah. It's
my
10
granny,
o'clock.
my granny used to say, God love his heart.
Guys, it's 10 o'clock. That means the end of Goat Talk for this Thursday. We appreciate you being here with us. We appreciate Bill for being here. Bill's a contributor here in the group. We appreciate him. Looking forward to meeting him and talking with him in New Orleans. If you haven't gotten your tickets yet, go to sub2palooza.com, get your tickets. You can book your room right there on the website while we still have rooms left.
Better do that quick.
They gave us a great rate on rooms there, and you can stay right there in location.
And I will tell you, you cannot book a day ahead or a day after. Okay. Yeah. And it'll come up and say there are no rooms available. So they are selling out quickly.
They are. That was the problem. We were shooting for October to do the event when it was just a tad bit cooler. But they've moved all of the spring carnivals to the fall. So we took the only dates we could get. That was beginning of September. So they are booked up. And I'm telling you, they gave us a rate on rooms that normally sell for about $300 a night. So
yeah.
Get over there.
Got a great rate on those rooms.
Yeah, get your right there at the Hyatt. So go get your rooms, get your tickets. Got 6 more days on early bird pricing. So Bill, again, thanks for being here. We appreciate your information. Great as always.
You bet.
You guys know how to contact him if you want his help with entity structure, taxes, trust, anything else. He said, hit him up on Messenger. That's the best way to do it. So you guys have a great day. Go out there, talk to some sellers, buy some houses.
Thanks, William. See you.
All right.